Okay. Uh, so last week we looked at the taxing rights of each of the, or as of each of the level of governments. We also considered the fiscal federalism last week, and we also deliberated on the FIRS board as the management of FIRS, and FIRS is established to administer all the taxes that is due, all the taxes that are actually due to the federal government. So, without overemphasizing on what we have done at our last class, so let us continue from where we stopped. So, in today's class, we are going to be looking at the assessments and what are the procedures for assessing our tax base. Now, the objective of carrying out an assessment by either the taxpayer or by the revenue authority is to ensure that the right taxes are being paid as and when due. And aside from that, it is also to ensure that all the taxpayers within a defined tax jurisdiction are also brought into the tax nets, and also ensure that the possible revenue leakages are being blocked. So that is the objective of assessments. You know, anytime a tax return is filed, it is imperative for the revenue authority to also perform their own assessments so that there will be a level of comfort on what the taxpayer has filed or what the taxpayer has disclosed in terms of the revenue or the income that will be subject to assessments during a relevant year of assessment. So that is on the objective. We have various categories of taxpayers, and because of these categories of taxpayers that we have, it also have an impact on how on how an assessment will be carried out by a revenue authority. Based on the taxpayers categorization that we have the individual or the enterprises, because the individual or an enterprise will be taxed based on personal income tax. So, and we know that the taxing rights of a level of government to individual enterprises, state governments, right? So, it is the state government that is responsible for collection and assessment of taxes of an individual or an enterprise. So, an enterprise is an entity that is registered as a business name. Then partnership as well. Who also has the taxing right for partnership? It is also the state government. And the taxes will be collected through State Board of Internal Revenue Service. Then we also have corporate entities that are limited by shares, and we also have a corporate entity that are not a profit-making organization, but they are always register, or they are usually registered as a company by guarantee. So those are the categories of taxpayers that we have. The taxpayer could be an individual or an enterprise. It could be the partners in the partnership business. Then it could also be a company, which might likely be either private limited liability company or public limited liability company, and as well as the non-profit making organizations, so that we often call NGOs. Now, what is the meaning of assessment itself? This is the official determination of a taxpayer liability by the relevant tax authority, such as Federal Inland Revenue Service or State Board of Internal Revenue. So that is an assessment. So if you hear that someone is saying, oh, I want to be assessed, or I want to go and do my self-assessment. So what we are saying in essence is that we are trying to determine the liability of such tax payer that will be remitted to the relevant tax authority. Personal income and trade income for individual under Personal Income Tax Act, or business profits for companies under Companies Income Tax, are to be assessed based on the relevant regulations that guides how such tax will be assessed. Now, we have various types of assessments. Number one is self-assessment. A taxpayer is required to disclose his income and also determine what the tax liability should be using the provisions of applicable tax law. So when a taxpayer determine, carry out the computation by himself using the relevant tax laws and regulations, we call that one a self-assessment. So after doing that self-assessment, the revenue authority might now perform additional assessment based on their own understanding, based on the relevant tax laws. And why they may also need to do that is to ensure that the taxpayer has accurately and appropriately carry out that assessment. So where they notice that there is a variance in the self-assessment, so they have that right to call on the taxpayer to come and pay the remaining balance based on their own computation. So as we move on, we will see how some of these things might play out, whereby the taxpayer may agree to the computation done by the tax authority, or a taxpayer might also reject the computation or the assessment that is done by the relevant revenue authority. Having discussed on self-assessment, we also have what is known as default assessment. So when a taxpayer fails to file a self-assessment, the revenue authority may estimate a tax liability and demand the taxpayer to pay that estimated amount. So that is a default. Another one that we have is also provisional assessment. Provisional assessments is a temporary assessment that is based on the prior year tax liability. So the tax is due for payments in one lump sum, not later than 31st of March in every year. So there may be some time, maybe for this one normally happens to when a company just commences a business. So the revenue authority may just look at it that okay, just come and pay something. So and it is basically based on maybe what what's it called, what the company or what the individual has paid in the prior year as a tax liability. So that's why we call it provisional. At least pending the time the proper assessment will be done, they may just call upon such taxpayer to come and pay something. So they will now use the past experience to do that. Then we also have what is known as the best of judgment assessment. After filing for self-assessment, the revenue authority may also decide that okay, what the person has disclosed as a revenue or what the taxpayer has paid as a tax liability is not appropriate. So they will now use their judgment. So in most cases, where they normally use best of judgment in most cases is for individual most of the time. So what they do most of the time is that they may just look for two companies that are on the same level. Let us take, for instance, at least we already know that in some industry, the payments of the remuneration for the executive might be very high. It might even be on a range. So let's say company A and company B operates in the same industry, and the managing director of company A is filing a return of, let's say, 60 million naira as annual income. And the company B that is also operating on the same level with company A, and the managing director of such company is now disclosing 20 million naira as an income. The revenue authority may use their discretion and say that no, you are a managing director, and we know that based on the survey that we have done, the minimum salary for managing director for the companies who are also operating in this industry is, let's say, 65, 70 million. So what they'll just do is that they are now going to charge additional assessments. You know, it was 20 million naira that the managing director disclosed. So they may just come and say, oh, these are our best of judgment. So you cannot just say that is how much you will pay. Then we also have turnover assessment. So the entity is assessed based on the turnover, and where it appears that in a particular year of assessment, the company has no accessible profit, the revenue authority may decide to use a revenue to assess that company for tax liability. And we also have what we call final and conclusive assessments. Final and conclusive, sorry. Final and conclusive assessment. So when an assessment becomes final and conclusive, there is nothing that could be done. But before an assessment could become final and conclusive, so it is very possible that such case might have gone to the courts, whereby either of the party file against the other party, either at the tribunal or at the High Court or till the matter will get to the Supreme Court. But once the tax becomes final and conclusive, there is nothing that the taxpayer can do about that. Because before a tax could become final and conclusive assessment, there is a there is a period that has been given to the taxpayer to object that assessment or to uh, accept the assessment. But if there is no any objection within a specified time frame as provided by the law, it means such liability becomes final and conclusive. Then moving on to objection of assessment and its process. I have also briefed us about the objection before an assessment could become final and conclusive. So when a tax authority or a revenue authority assess the company, it may be an individual or it may also be a company. So when they bring their own assessments, the taxpayer, either the company or the individual, may reject or it may also agree to the notice of assessment. So when they are bringing that notice of assessment, they will have told you that, okay, this is what they have assessed you on. Most of the time, whenever tax authority issues notice of assessment, they are not telling you to just come and pay immediately. They know that if they give you unreasonable figure as a tax liability, then you will also want to take an action to quickly come and file your returns or do what is really necessary from you. What is necessary by you. So what they will now do is that when they issue that notice of assessment, maybe after you have submitted your own returns, you have submitted your own self-assessment, they now do their own recomputation, they do their own reassessment. They are now, okay, maybe initially you have your own self-assessment that you carry out. On your own self-assessment, let's say your tax liability is, let's say, 2.5 million, right? But when they now provide their own notice of assessment, in their own notice of assessment, they are now giving you, let's say they are now giving you 18 million. So what you need to do is that is either you accept this 18 million naira with them, or you reject this 18 million. And when you are rejecting, what are you supposed to do? When you receive this notice of assessment, the first thing you need to do is that if you are aggrieved with the amount that they are giving you, you are supposed to write back to them. You are supposed to write to them within 30 days. You are supposed to write notice of objection. You give them notice of objection that no, you are not accepting what they are providing to you. Then when you are giving them your notice of rejection, number one, you don't just write the letter. You need to give them the basis. You need to give them the basis on how you compute your own notice of, on how you arrive at your own tax liability. So then you also support, it is also very good that you support your response with relevant support documents. Let me give you an instance. Let us assume that they have an access to your bank statement. Every company has an access. Every tax authority has an access to company's bank statement, except if they just don't want to go through that stress. So let's take, for instance, that they notice the company, a very big company, a big company, right? And that company has been designated as I maybe that company has been designated as high taxpayer, mm, high taxpayer. But when the company now file, let's say 2 million naira tax liability, and they are like, no, it's not possible. Why will the company just file 2 million naira? They will say, okay, the tax liability of this company is 50 million naira. So before they can do that, they will also provide you with their own basis that this is what they have used to compute the tax to be 50 million. So it is now your own responsibility. Assuming there is a credit in your bank statement, let's say there is a credit of, let's say, 100 million naira, and that credit is more or less like a loan, but they are now considering it as a revenue. So because they consider it as a revenue, they just charge 30% on this one. Okay, let me say 500 million. So they just charge 30%. Should I use okay, okay, let us use 15, let us use 500 million. So when they are now charging this 50, then when they now realize that this 500 million is your account, and they realize that you did not account for it as part of your revenue, they just charge you 30% of it. And the 30% is 150 million now, right? And your own tax liability, maybe the one that you pay, let's say that one is 20 million. So after you have considered all the allowable expenses that you need to bring into your record. So when you are now returned, they will tell you that, okay, there is a revenue of 500 million naira that you have not recorded, that you've not recorded. So it is not left to you to now tell them that, oh, this 500 million naira relates to a loan, that it is not a revenue, it is not an income, that it is a loan. So if you are going to do this, you need to support your response with maybe the loan agreements, how you receive the loan, the day you receive the loan, and all those things. So when they receive it, they may now issue an an amendment. They may issue amendment of assessment. So when they issue the amendment of assessment, so they will, two of you need to agree on a, as you need to, you need to have a ground whereby you both agree that, okay, this is it. So if at the end of the day they are insisting that no, they are not going to amend, and you two are now saying that you are not going to accept it from them, so the next thing you need to do is to file with the tax appeal tribunal. You file with tax appeal tribunal. So when you are filing with tax appeal tribunal, so what you just need to do is that before you can file this tax appeal tribunal, they must have also given you what we call notice of refusal to amend. Notice, they will have given you notice of refusal to amend. So when they give you the notice of refusal to amend, so it is this notice with all your correspondences with them that you will now file with tax appeal tribunal. When you are filing, you file with the secretary of the tribunal. You need to file within 30 days. You need to file within 30 days. There may be an instance whereby this letter is dated. Let's say this letter is dated on the 5th of January, right? If the letter is dated on the 5th of January, it is expected that you file this return, let's say by on the 3rd, because it is 30 days, not 1 month. You file by on the 3rd of February. No, yeah, you need to file by on the 3rd of February with the tax appeal tribunal. But there may be an instance whereby when they issued this letter, it was on the 5th, but the letter did not get to you until, let's say, 25th of January. So if there is a reasonable evidence that this is when you get this letter, you may file between, let's say, you may file, let's say, by 25th or by 24th of February of the following month. So when you do that, it can still be accepted. But if the date that they if the dates on the letter is also the same date that you received the letter, you need to file within 30 days. And when you are filing with Tax Appeal Tribunal, you need to make your filing known. You need to make it known through the secretary of the tribunal. And when you are doing that, you need to provide your you need to provide some relevant information, such as your name, the tax file number, the date the applicant was served with the notice of refusal to amend by the revenue authority. So you also need to indicate the date that the letter was sent. But if the date that the letter was sent is different from the date that you received it, you may need to indicate. Then the taxable profits or the income that both parties are agitating on, the as in where you have that as in where you have that contrary agreement on. So, or whether it is on income or it is on the profit, you need to state it. And then the amount of tax that is being disputed. So if you are saying that your own tax is 20 million and they are saying their own tax that they have computed for you is 100 million, you also need to indicate it. And then the grounds, on what grounds are you appealing are you appealing to the tax tribunal? So that is the process. So invariably, in summary, the filing with the tax appeal tribunal should be done within 30 days. Then before the hearing of the tax appeal tribunal, because sometimes it may be an individual, a company that will go to the tax appeal tribunal, or it may also be the revenue authority itself. So if the company insisted that it's not going to do anything and they are just going back and forth on it, the revenue authority may decide to file against the taxpayer at the tax appeal tribunal, because tax appeal tribunal is established to resolve any tax matters. So if the tax matters could not be resolved, either of the party, the aggrieved party, may now go to the high courts. And if the judgment is also not favorable to one of the party and the other party still believes that no, he or she cannot accept the position of either the tax authority or either the client's position, they may drag that matter to Supreme Court, and whatever decision made by Supreme Court becomes final. So let us now look into the uh, tax appeal tribunal. But before that, I was explaining the cancellation of appeal. If before the hearing, the two parties, the tax authority and the taxpayer, now have a common level ground, they now have a unanimous agreement that, okay, this is what should be. So the clients, the taxpayer is expected to write, or anyone who filed with the tax appeal tribunal, either the taxpayer or the revenue authority, needs to write the appeal to the tax tribunal and informing them that this matter has been settled, that there will be no need for the hearing, so that once that one is done, the parties involved will also be circularized, just to be confirmed and to be sure that that matter has really been resolved by both parties outside the court. Then Tax Appeal Tribunal is an administrative body established by the Federal Inland Revenue Service Establishment Act to hear and resolve tax disputes. I've said this the other time. So their responsibility is to hear and then to also resolve the tax dispute from all the federal tax legislation, which includes company income tax, personal income tax, petroleum industry acts, petroleum industry acts. That's wrong. So petroleum industry acts, so it's also part of it. Then we also have value added tax acts, capital gain tax, stamp duty tax, and levies. Then we also have approved list of collections acts and all regulations or rules issued in terms of taxes. So that is what the tax tribunal, tax appeal tribunal, that is what they are established for. And we have all these tax appeal tribunals in 8 zones. These 8 zones represent each geopolitical zone, and then Abuja is treated as separate from the states, from the region rather, than Lagos too. So if we add the 6 geopolitical zone that we have, if we add them to the Lagos Tribunal and then the Abuja Tax Appeal Tribunal, then they become 8. And each of the Tax Appeal Tribunal is expected to have its own tax appeal commissioners. So what are the composition of our tax appeal tribunal? So the appeal tribunal shall comprise of 5 members, and the 5 members shall be referred to as appeal commissioners, tax appeal commissioners. And these tax appeal commissioners must be appointed by the Minister of Finance. The chairman of each zone shall be a qualified legal practitioner with no fewer than 15 years of post-qualification experience. And such person must also be experienced in tax law and taxation issues. The chairman shall lead the tribunal sittings. If absent, the members must select an acting chairman from among themselves. So what we are saying here is that every tax tribunal we have 5 members. Then from the 5 members, there shall be a chairman among them, and this chairman must be of person with a relevant experience in tax law and taxation issues of not less than 15 years. Then a quorum can also be set if the before a quorum can be set, it means there must be a minimum of 3 members. So which means whatever decision that are made by the 3 members, it is binded by the remaining 2 members that are absent. But in this situation, anytime the chairman is not available, it is expected of the members to select or to appoint someone among them as a chairman for that particular hearing. Then the term of office and remuneration of a tax appeal commissioner. The tax appeal commissioner has 3 years to spend at the office, then with additional 3 years if the term is renewed. But if it is not renewed, it is 3 years that the tax appeal tribunal is expected to use. But in a case whereby a tax appeal tribunal is already close to 70 years, so let's assume that the person has spent, the person is expected to spend 3 years, But as at the point, or as at the time that this tax appeal commissioner was appointed, let's say the person was already 68 years. So what it then means is that as in whichever is earlier, either the 3 years or the 70 years. So which means by the time this man will spend 2 years, 2 additional years, it will be 70. So it means such tax appeal commissioner cannot spend 3 years at the office. So that's why the law has it to be whichever is earlier. Then their remuneration and allowances shall be determined by the RMAFC, that is also known as Revenue Mobilization, Allocation and Fiscal Commission, and their remuneration shall be specified in the letter of their appointment. The resignation and removal of tax appeal commissioner. So a tax appeal commissioner can also in writing resign from his position before the expiration of his tenure in the office. But before that tax appeal commissioner could leave the office, maybe on a resignation basis, at least it must give a 3 months notice, except if the minister wants to discharge the person immediately. But in a situation where the minister is not ready to discharge the person immediately, it means the tax appeal tribunal is expected to give 3 months, but there is a condition whereby these 3 months may not also be adhered to. If there is no person, if the notice period has not expired, but a successor is already appointed, that tax tribunal commissioner could also leave. But in a situation where they've not gotten any other person to take over that role, so it means the person will need to spend that 3 months. And if after the 3 months, they've not also gotten someone that will replace that tax appeal commissioner, the person can leave because he has already completed his notice period. Then a tax appeal commissioner could also be removed from the office. But before such tax appeal commissioner could be removed from the office, they must first inform such tax appeal commissioner in writing. They must notify him or her. Then the basis for which his removal will be done will also be communicated to him or her. And the tax appeal commissioner shall be given a fair hearing. He or she will also be given an opportunity to be heard of, so that it will not look as if the person appointed as a tax appeal commissioner is not given a fair hearing, or maybe that person also was also removed from the office without any uh, fair hearing from the other side. Then there is also a secretary of the tax appeal tribunal, and the work of the secretary is to keep the records of the proceedings, to keep the record of the meeting, and then the secretary will also serve as the head of the secretariat and responsible for the day-to-day administrative activities. And then the secretary of the tribunal will also be responsible for the direction and control of all the employees. So what are the matters? What are the tax matters that the tax appeal tribunal could adjudicate on? So anything from the Company Income Tax Act, Personal Income Tax Act, Petroleum Industrial Act, Value Added Tax, capital gain tax. Then we also have stamp duties. Stamp duties acts. Then approved levies and collections. So these are the various matters that the tax appeal tribunal could adjudicate upon. Then what are the powers of tax appeal tribunal? The powers of tax appeal tribunal is to make rules that will regulate its procedures. It's also to summon and enforce attendance of any person and examine him on oath. It can also call for the examination of witnesses or documents. They can also do anything which, in the opinion of the tribunal, is to its functions. It can also dismiss an application for default or deciding matters experts. They can also receive evidences on affidavits. So these are all what you have about the assessments, as well as the objection of assessment, and also filing with the what's it called, with the tax appeal tribunal. And when we are even filing the notice of objection, so it is expected that this will be done on 3 basic conditions. The objection must be in writing, as when you are filing notice of objection, you cannot just use mouth to go and explain. You need to do it in writing. Then you must also state the specific, you must also state the ground of your dissatisfaction, and then the rejection must be submitted within 30 days of receipt of the assessment. So this is all we'll be doing on the assessments, tax appeal tribunal, and the rest. So any questions so far? Any question?
No question.
Okay. So we'll be continue from where we stop, and we are moving. So what I will need to do now is that I will pause this this recording, sorry. I'll stop this recording so that the next one that we'll be doing, because it's a different topic entirely, so we'll also start on that one. I hope you understand what I'm saying, right?
I understand you.
Okay, thank you. Let me stop the recording.